Hello, welcome everyone, both in the room, council members, board members, and those attending via Zoom and those observing. Want to extend a special welcome as we get started today to Dave Sullivan. Dave will be replacing me as the FASAC chair in January. He's had a long, successful career at Deloitte. He had time at the FASB in his early in his career, so I guess you can come home again. And he also spent time on FASAC, and he's going to be a great addition to the team, and I think you'll really enjoy working with him. We also have with us Haley Krebs, chair of the Auditing Standards Board from the AICPA. This is her first time observing a FASAC meeting. And we have Zach Altoff, who graduated from University of Texas, El Paso, and joined the FASB in July as a PTA. So just some logistics as we get started here. Typically, as given the mixed format of the meeting, Alicia will keep track of in-person and virtual queue when the discussion gets active. For those of you who joined us virtually, please use the raise hand feature on Zoom when you'd like to speak. And also, just a reminder, please keep your audio on mute when you're not speaking. For those in the room, please turn your name card on your end to share your observations or to ask questions. And for those at the far end of the room, if you have to wave a little bit, we understand it's a long room. If you have a comment or question that's directly on point, please use your double hand signal, touchdown signal, and I'll call on you as soon as possible to follow up on a point. When you've been called to speak, just a reminder to press the button at the base of your microphone. It'll light up green. After you're finished speaking, you can press the button again to shut your mic off. So as we like to do, let's go around the table and do introductions. So I'll start with Alicia.
Alicia Manders, FASB staff.
Dave Sullivan, incoming FASAC chair.
Nellie Dubler, FASB Deputy Technical Director.
Rosemary Sangiulo, FASB Deputy Technical Director.
Joe Holmes, Thermo Fisher Scientific.
Brandon Coleman, Deloitte.
Suzanne Skaggs, Bechtel Corporation. Sarah McVeigh, University of Washington, faculty.
Haley Krebs, chair of the Auditing Standards Board.
Stacey Harrington, Microsoft.
Yen Zhang with Eisner-Amper.
Christine DeFabio Zoetis.
Fred Cannon, FASB member.
Jim May, NextEra Energy.
Deanne Bruntz, B&G Foods.
Marcia Hunt, FASB member.
Debbie Dial, Audit Committee Director.
Greg Ketron, Invesco.
Sue Cosper, FASB.
Heather Jotham, PCOB, Office of the Chief Auditor.
Rich Jones, FASB Chair.
Jack Day, Technical Director.
Garv Hiranandani, SEC's Office of the Chief Accountant.
Hillary Salo, FASB Vice Chair.
Steve Steuben, University of Utah.
Monica Losman, Gibson Dunn & Crutcher.
Joyce Joseph, FASB member.
Morning, Matt Shinzek, Procter & Gamble.
Hi, Adam Brown at BDO.
Vice President, retired at Johnson & Johnson.
I'm going to stop for a second. I don't usually do this during introductions, but Stephen forgot an important addition to his titles. He became a grandfather for the first time yesterday.
You know, and Mike is blueberry crumble outside.
I know, he still did that. He added that. It's amazing he had the time for that. Okay. Congratulations.
Tim Codrington, Fidelity.
Christine Bodison, FASB member.
Saul Martinez, HSBC.
John Bullock Parr, Bank of America.
Dan Murdoch, Comcast Corporation.
Jeff Brickman, FASB Investor Liaison.
Vivian Sisson, FASB staff.
Erica Friends, FASB staff.
Tiffany Wiskowski, FASB staff.
Zach Altoff, FASB staff.
James King, FASB staff.
Liz Gagnon, FASB staff.
Great. We also have some folks joining us on Zoom. I'll start with Tom.
Tom Barbieri, PwC.
Ashley.
Ashley Baum, Texas Teachers.
Jeremy.
Jeremy Croucher, KPMG.
Robert.
Bob Dacey, Government Accountability Office.
Yanni.
Engelhardt, Shillett Forensics.
Eric.
Morning, everybody. Eric Johnson, CNO Financial Group.
Shripad. I think you might be on mute. Okay, well, let's move on to Jeff. Oh, sorry, Shripad. Are you live now?
Shripad Joshi, S&P Global Ratings. Sorry about that.
Great. That's okay. Jeffrey.
Jeff Karbowski, Netflix.
Jill.
Jill Lehman, former Director of Research of CFRI.
And Richard.
Yep, Richard Sloan, University of Southern California.
Great. Thank you, everyone. We have 4 topics on our agenda for today. Our meeting is scheduled to be completed by 3 p.m. We'll start with highlights on current and hot topics from the FASB, the SEC, the PCAOB, and the AICPA. Then we'll begin with our first topic, agenda consultation. It will include breakout discussions followed by a full group discussion. Second topic will be effects of use of technology on standard setting, which will also include breakout group discussions. Have a break for lunch at 12:45, reconvene at 1:40 to resume our discussion on technology. And then we'll conclude the meeting with a discussion on post-implementation review, current expected credit losses, or CECL. John's available throughout the day if you need help with transportation or any logistics issues. So I'll turn it over to Rich Jones, the FASB chair, for highlights on recent FASB activities.
Great. Thanks, Mike. I guess my report's coming here from the west end of the table, and it's a bit of a distance. So I did just want to welcome everyone. Thank you for taking time out of your busy schedule to come share your thoughts with us here today. I do want to remind you that we have some folks that are going to be rotating out. While there's a final meeting, the final meeting is virtual. So if there's anyone whose hand you want to shake or informal conversations you want to have, I might remind you to do them today because the next one's a little harder on Zoom. So, and I also want to welcome Dave Sullivan. Dave, it's great to have you here on your training sessions. I know you don't need them, but while we'll miss Mike, we're excited to have you join us at the beginning of next year. A couple things that I just wanted to give you an update on. You do have a copy of the chair report in your materials, but beyond that, if you haven't had a chance, we've posted our 5th annual investor outreach report on our website. We started doing this about 5 years ago, and one of the reasons was because I thought the FASB did a lot of great investor outreach work. The problem was we weren't summarizing it. It wasn't coming necessarily in the form of comment letters. And part of the reasoning behind this was really to be transparent with all of our stakeholders about all the work we do with investors. You'll see over the last 5 years, there have been over 2,100 investor interactions that have helped shape our agenda, the standards that we're setting. Please take a look through the report, and we're always open to suggestions, whether it's through investor outreach or any kind of stakeholder interaction, any ways that we can improve. So we're all ears, but please share your recommendations as we're always trying to pull more people into our process. Couple updates from our trustees. Our trustees recently reappointed Fred Cannon to a 2nd term. So you'll have the privilege of seeing Fred for another 5 years. So congratulations, Fred. You'll also note that they appointed Dahlia Blass as the incoming chair of the Board of Trustees. Her term will start on January 1 of next year. And also Erin Hill is going to be coming on board, replacing John Auchincloss as the executive director of the foundation. Erin will be on shortly. I believe she starts on October 1st. And John's had a long tenure. He's been the executive director as long as I've been a chair, a great partner to work with. We'll miss John, but we're looking forward to welcoming Erin into the fold. Turning to our technical agenda, we currently have 11 projects on our technical agenda. 9 of them have been voted out by our board to proceed to final standards, including the project on software, which should be issued later today. So I do want to thank FASAC. You've had a lot of involvement in moving those projects forward. And there's been a lot of effort by our staff invested in. It sounds great. The board votes final project, but it's not done. We have the final drafting, the review from the board, review from stakeholders, making sure that we get it right in that final standard. So our staff's working very hard on that and been kept very busy through and will continue to be so through the remainder of the year. I also thought it was probably a good chance to just reflect back. In 2022, we had done a comprehensive agenda reset. And we've brought many of those topics in front of FASAC over the last few years. But I do just want to thank FASAC because and give you a quick summary of some of the projects that we've talked about with FASAC and that we finalized. They include projects on digital assets, income tax disclosures, segment reporting, disaggregation of income statement expenses, definition of a derivative, government grants, software, purchase financial assets, environmental credits, all proceeding to final standards. And that's only a portion of our agenda, but those were all active discussions with FASAC over the last few years. In addition, FASAC was able to weigh in on the statement of cash flows, as well as our research projects on financial KPIs and intangible assets, two items that are either partially on our technical or research agendas, where the input from FASAC is very valuable as we decide are there projects there and what directions they should go. So did just want to say thank you. It's been a busy time on FASAC. New FASAC members, don't worry, we're not all done. We're going to talk a little later today about our agenda consultation, and we'll continue to talk about the, 9 projects on our research agenda with FASAC on an ongoing basis. So I do want to thank you and look forward to today's discussion and ready to answer any questions if there are any. Mike?
Any questions for Rich? Dan?
Hey, Rich, in the materials I saw that you issued a FASB staff educational paper, which I'm relatively unfamiliar with. Can you talk a little bit about what that is and how you guys go about thinking about when that's the kind of a necessary thing?
Sure. And do you know which research paper?
Yeah, I think it relates to the construction. And that was a source of the PCC asked us to do that.
So yeah, Dan, and they're few and far between, but occasionally we will get a question about the application of existing GAAP. And we do have a technical inquiry service and we'll sometimes answer them. That's an issue that came up through the PCC where there was a question, did we need to do standard setting? And we initially headed down a path of potentially doing standard setting. What we discovered was actually through input from our stakeholders was the answer was already clear. We then had a choice. Do we simply say we drop the project, say at a meeting, the answer is clear, or is there something else that we can do to help our stakeholders in that area? Given this dealt with private companies specifically, and it was helpful for smaller firms and private companies to have something to point to, we decided to go down the path of here was the rationale under existing GAAP as to why that answer was clear, but here's some other things that someone could do if they chose to do them. We're pretty careful when we do that. I would say it's more about making sure that a point can be shared with people or news can be shared with people so they don't have to rely on word of mouth or finding it in a firm publication or so on. But by the same instance, we want to be very careful that we're not setting GAAP through those other means. So you don't see them very often, but that was the purpose for that one, Dan. Thanks.
Any other questions for Rich? Thanks for going through that list, Rich. I think I speak for all the members that we appreciate the degree to which the board is actively involved and, inquisitive about our discussions, and we really enjoy giving feedback. And so thanks for the board's willingness to listen to it. So why don't we move to recent updates from the SEC? I'll turn it over to Gaurav.
Thanks, Mike. As always, it's truly a pleasure to be here with you all in person today. Let me start with my disclaimer that my comments and any views I express today are provided in my official capacity at the Commission's Office of the Chief Accountant, but don't necessarily reflect the views of the Commission, the Commissioners, or other members of the staff. Before providing an update on Commission activities, I'll start with some personnel-related matters since we last met in June. First, we're very pleased to welcome back Kurt Hull as the SEC's Chief Accountant. He joined in early July. Kurt brings nearly 40 years of accounting and auditing experience, both from his prior service at the Commission as well as his leadership roles in the private sector. It's really terrific to have him back, especially at an important moment, both for the agency and the profession. I'd also like to take a moment to thank Ryan Wolf, who served as the acting chief accountant in the interim. Ryan continues to serve as the chief accountant for the Division of Enforcement. Next, James Maloney was recently named as the director of the Division of Corporation Finance. He's a longtime securities lawyer who was also previously at the Commission in the Division of Corporation Finance's Office of Mergers and Acquisitions. He brings a wealth of experience as well. And relatedly, Cicely Lamoth, who's currently serving as the acting director, will return to the Deputy Director of Disclosure Operations, the Division of Corporation Finance, once James' tenure becomes effective next month. Now moving to an update on recent SEC matters. The Commission has been busy since we last met, and so I'll just share a handful of items. First, in late June, the SEC held several executive compensation roundtables, really to better understand stakeholder views on certain executive compensation disclosures, such as the pay versus performance and the pay ratio disclosures. Broadly, participants noted complexity and cost with the current rules and suggested less prescriptive rules. In mid-July, the Genius Act was passed by Congress and signed into law by President Trump. The Genius Act provides a framework for regulating payment stablecoins. Following its passage, Chair Atkins directed SEC staff to consider whether guidance, rulemaking, or other steps may be helpful or necessary to accommodate the SEC registrants utilizing payment stablecoins, including for settlement and margining. In late July, Erica Williams stepped down as the PCAOB chair, and George Bodick was designated as the acting chair. Shortly after, Chair Atkins announced the commencement of the appointment process for all 5 PCAOB board positions, including the chairperson. Those interested were encouraged to apply by the end of August, so OCA is currently working through the administration of the PCAOB board member selection process. Next, in early September, the Commission released its Spring 2025 regulatory agenda, commonly known as the RegFlex agenda. The items on the agenda represent the Commission's renewed focus on supporting innovation, capital formation, market efficiency, and of course, investor protection. The agenda covers potential rule proposals related to the offering and sale of crypto assets to help clarify the regulatory framework for crypto assets and provide greater certainty to the market. It also covers a number of rule proposals to modernize and update rules as well as reduce burdens, really to facilitate capital formation while also protecting investors. And some of the ways it'll do that is by simplifying pathways for raising capital and improve investor access to private businesses. The proposals include looking at things like filer status, so accelerated, non-accelerated, small reporting company, looking at FPI designation and eligibility, shelf registration modernization, as well as the rationalization of disclosure practices, just to name a couple. And lastly, I would highlight there have been some recently released statements, including from the staff of the Division of Corporation Finance, on topics such as crypto asset exchange traded products, as well as certain liquid staking activities. And I'd encourage anybody interested to visit the sec.gov website, where staff statements, as well as the regulatory agenda are available, as well as updates on generally all the Commission activities. And finally, I thought it'd be helpful to just share some of the consultation themes that we continue to see in OCA. As a reminder, every question we address on the accounting side deals with very specific facts and circumstances that relate to a registrant's arrangements. So we continue to see and receive questions related to acquisitions and divestitures, as well as entities seeking non-traditional forms of financing, such as R&D funding arrangements. More recently, we've also received questions and consultations related to crypto asset activities, questions for accounting for stablecoins, both by the holder as well as the issuer, as well as questions related to accounting for certain novel crypto activities, such as revenue recognition related to staking. And with that, I'm happy to take questions, but also very much looking forward to the discussion today.
Any questions? Okay, thank you. Very thorough report, and I'll turn it over to Heather for an update on PCAOB activities.
Good morning, everyone. It's a pleasure to be here. Before I begin, I need to provide our standard disclaimer that the views expressed are offered in my capacity as staff of the PCAOB's Office of the Chief Auditor, but they are my own and do not necessarily reflect the views of the board as a whole, any individual board members, or other PCAOB staff. Today, I'll share some highlights of recent PCAOB activities. And in consideration of the topics of today's meeting, I'll begin with PCAOB activities related to the use of technology. Earlier this month, 2 deliverables of the Technology Innovation Alliance Working Group of the PCAOB, which concluded its work in August 2024, were released to the public. The first document, titled The Current State Deliverable, is a study that offers perspective on the current needs and motivations of investors and others, the broad evolution of auditing, an overview of the current state of technology in auditing and financial reporting, and challenges related to technology adoption for auditors and preparers. The second document, titled Transforming Audit Quality Through Technology, is a report that provides further context on the use of technology in auditing and presents 4 strategic ideas on ways that the PCAOB can promote the use of technology in auditing, including promoting structured data creation and dissemination in public company audits, focusing on the use of AI in public company audits, regulatory innovation capacity building to facilitate ongoing innovation in audit quality, including by establishing an innovation lab, and encouraging technology literacy and auditor skill sets. The PCAOB has an ongoing data and technology research project with the objective to assess whether there's a need for guidance, changes to PCAOB standards, or other regulatory actions in light of the increased use of technology-based tools by auditors and preparers. This includes evaluating the role technology innovation plays in driving audit quality. In addition, technology-related issues have been a topic of discussion at the meetings of the PCAOB Standards and Emerging Issues Advisory Group. Now turning to standard setting activities. The PCAOB continues to devote significant time to assisting firms with the implementation of QC 1000, a firm's system of quality control. In July, the PCAOB hosted 2 virtual workshops designed to assist smaller audit firms with the implementation of QC 1000. The workshops were specifically geared toward individuals at smaller firms who are directly responsible for implementing QC 1000 and provided hands-on activities related to the practical implementation of the new standard and opportunities to engage directly with PCAOB staff. At the end of August, the PCAOB announced that it is postponing for 1 year to December 15th, 2026, the effective date for QC 1000 and other new and amended PCAOB standards, rules, and forms adopted by the board on May 13th, 2024. The board's action also postpones the rescission date of certain existing rules and standards. The decision to postpone the effective date takes into account information from various sources that firms have encountered implementation challenges. The board believes that the additional year is sufficient time for firms that have encountered implementation challenges to overcome those challenges. The board has not made or proposed any changes to the text of the new and amended standards, rules, or forms from the text adopted by the board, nor is there any change to the board's previous statement that registered firms are permitted to elect to comply with the requirements of QC 1000 before the effective date. Next, I'll provide an update on recent inspection trends. In June, the PCAOB released its annual report on the interim inspection program related to audits of broker-dealers. The 2024 inspection year marked the PCAOB's 10th year of inspection of firms that are required to audit broker-dealers in accordance with PCAOB standards. During 2024, the PCAOB inspected 60 firms and reviewed 102 broker-dealer audits. Overall, in 2024, the PCAOB continued to observe high deficiency rates in examination review and audit engagements. The PCAOB identified at least 1 deficiency regarding the sufficiency or appropriateness of evidence that firms obtained to support their audit opinions in 68 or 66% of the 102 audit engagements that were reviewed during 2024, an increase of 10 from 2023. The areas where the PCAOB identified the most deficiencies were revenue, journal entries, and evaluating audit results. Last week, the PCAOB released a staff publication, Broker-Dealer Audit Focus, review engagements regarding exemption reports that highlights key reminders for auditors of attestation standard number 2, provides the staff's perspectives on common deficiency observed in auditors' work, and shares good practices that PCAOB staff have observed. The Broker-Dealer Audit Focus is a new series of PCAOB publications that aims to provide easy-to-digest information to auditors of registered broker-dealers. Lastly, I'll highlight some recent resources for smaller audit firms. In July, a new Audit Focus publication was released on engagement acceptance. This edition of Audit Focus highlights key reminders for auditors who audit small public companies of PCAOB standards related to engagement acceptance for initial engagements for new clients. The Audit Focus also shares good practices that the PCAOB has observed, including assessing partner capacity, implementation of a pre-assessment process, and the use of templates. In August, the PCAOB announced the formation of the Smaller Firm Resource Group, an advisory group of professionals from smaller audit firms. The Smaller Firm Resource Group will advise PCAOB staff on auditing and related professional practice standards, inspection and related activities, and economic considerations. And earlier this week in Texas, the PCAOB hosted another in-person forum on auditing in the small business environment and on auditing broker-dealers. All of the resources I've mentioned, as well as the different information, are available on the PCAOB website. This concludes my prepared remarks, and I'm happy to answer any questions you may have.
Thank you. Any questions for Heather? If not, I'll turn it over to Howie for a quick update on the AICPA activities.
Thank you very much for having me. I was actually a fellow at the FASB many years ago, so it's nice to be back in a different capacity this time. I will say standard caveat as well that I am here in my capacity as the chair of the Auditing Standards Board, but my views expressed are my own and not necessarily those of the board or any other individual board members. In the interest of time, I'm not going to go into all of the various projects that we have going on at the Auditing Standards Board, but I did want to mention a couple of things that I thought were relevant to today's meeting. The Auditing Standards Board has recently undertaken a project to review and update our strategy and work plan. And in doing that, we sought feedback, including on our agenda. So I appreciate the project the FASB is going through and the importance of doing that and getting feedback from the public on those topics. We are still very much in the midst of analyzing the feedback that we have received, but one topic or one theme that we have noted from various stakeholders is related to the technology topic. And I think that manifests itself in a variety of ways, including how auditors are using technology in their audits, how the clients or the companies that we're auditing are using technology in their financial reporting, and then even as a standard setter, how we are using technology in standard setting. So I thought that the topics that you all have on the agenda today are definitely pertinent from what we're seeing as well. Thank you.
Great. Any questions for Howie? Okay, well, thank you. So we'll move on to our first topic, which is the agenda consultation. And I think this is one of the most important things that we do as a council is to give the board our feedback. We're getting this at the very beginning of the process. I'm sure we'll come back to it at different points in time. So we're getting almost a preview. I don't even think the board has had a chance to go through in detail the findings that we'll talk about today. So I'm going to turn it over to Erica Friend, Senior Project Manager at the FASB, who's here with Tiffany Wiskowski, who's a Project Manager, and Vivian Sazzone, PTA.
Thank you, Mike. Good morning, everyone. In September of 2024, we met with FASAC as part of the kickoff to our agenda consultation process, where we asked members really the open-ended question of what should the board work on next. And this was part of our broader outreach efforts that we performed in the second half of 2024, which included talking to a cross-section of over 200 stakeholders to identify what the priorities should be. The feedback from FASAC and other stakeholders that we talked to shaped the content that was included in the Invitation to Comment Agenda Consultation, or ITC, as I'll refer to it, that was issued in January of 2025. As a reminder, an invitation to comment, similar to our other ITCs, is a staff-issued document, and it included no board views. Sorry, go to the next slide. The comment period in the ITC ended on June 30th, 2025, and over 120 responses were received through the end of August on the document. The next slide gives you some perspective of where we are in that process. So the staff is currently in the process of summarizing the feedback for the board, which will be presented to the board meeting this fall, and we're going to highlight some of that feedback for you today. The board will then analyze this feedback against its 3 agenda decision criteria as part of its overall agenda prioritization process, and then it'll decide how to make changes to its agendas. This could include changes that the FASB chair makes to the research agenda, as well as changes that anything the board would like to add to the technical agenda. Once the board has completed analyzing this feedback and made changes to the agenda, an agenda consultation report will be issued, which will highlight how the feedback was considered and how it influenced the standard setting. So in the next slide, we can see that we received 129 responses. This includes responses from comment letters, stakeholder outreach meetings, as well as advisory groups. And this was what we received through the end of August. You can see from this pie chart that it came from a cross-section of types of stakeholders, including investors and investor advocate groups, preparers, practitioners, trade groups, and many others. The stakeholders that we heard from represent a variety of industries, including financial services, pharmaceuticals, insurance, oil and gas, energy and environment, crypto, among many others. The next few slides, we're going to give you a sense of a very high level what topics stakeholders concentrated their feedback on and how they prioritized certain topics. This slide highlights select topics that were included in the ITC document, and it highlights the percentage of respondents that identified each of these as top or low priority. There was a wide range of perspectives that we received across topics. While some topics, as you can see, were consistently identified as top or low priorities by stakeholders, other topics received more varied responses, with views split between top and low priority. For example, some topics like enhanced disclosures, equity method of accounting, distinguishing liabilities from equity, asset retirement obligations or AROs, and consolidation for business entities received fairly mixed feedback. Conversely, respondents seem to more clearly indicate that other topics, such as risk management and hedge accounting and outdated disclosures, should be a top priority, and that other topics, such as recognition of interest income and estimate of variable consideration, should be a low priority. On the next slide, we've highlighted a few of the topics that were most frequently identified by kind of three major stakeholder groups: investors and investor advocates, preparers, and practitioners. As you can see, there are differences in views among these three groups about what the board should address, with not really any overlap between these top priorities across the three groups. Investors and investor advocates primarily identify topics that related to enhancing financial reporting information as a top priority, while practitioners and preparers focus really on topics related to making targeted improvements to reduce unnecessary cost and complexity in GAAP. So members will discuss four of the topics that are included on the slide today. These are some of the most frequently identified priorities that had mixed feedback. This includes equity method, consolidation, AROs, and distinguishing liabilities from equity. And I'm not going to go through all the details of the feedback on those four topics right now, but a detailed summary of those were included in attachment 2B of the materials. So moving on to the next slide, the ITC was organized into 8 chapters, and this was really, we kind of logically grouped them into areas of GAAP, although there are cross sections between some of the topics in the chapters. So these were broader areas such as combination of entities or financial instruments, as well as on the research agenda. So I'm going to go through at a high level the feedback on the 8 chapters that we received, and how stakeholders identified those as top, low, or neutral. I'll touch on a few observations on each slide. We would be here all day if I touched on all of the feedback, but I'm going to highlight also the 4 topics that will have discussion questions for members today. And just a note on that neutral, so we have top and low, which are pretty self-explanatory, but neutral indicates what stakeholders, they didn't necessarily identify it as a top or a low priority for the board to address, but they were open to standard setting and wouldn't object if the board decided to take it on, and gave some feedback on how the board could proceed if they did. So as far as chapter 1, which was a whole bunch of topics that related to combination of entities broadly, equity method received the highest volume of feedback of the chapter 1 topics, and stakeholders provided really mixed views on whether this topic should be addressed as a priority, and if so, how the board should address it. For this topic, stakeholders provided feedback about whether the equity method should be eliminated, and if equity method investments should be required or permitted to be accounted for in accordance with other equity securities in topic 321. Another topic to highlight here is the interaction of the consolidation guidance and other transactions was frequently identified as a top priority, and this feedback on this topic primarily related to differences between business combination and asset acquisition guidance. Moving into chapter 2, this was about financial instruments, risk management and hedge accounting, alternative funding arrangements, and distinguishing liabilities from equity were amongst stakeholders' top priorities in chapter 2 related to financial instrument topics. For these, all 3 of these topics, really stakeholders provide mixed views on whether they should be addressed as a priority, and if so, how the board should address them. Alternative funding arrangements was primarily identified as a priority by stakeholders that would like the board to address the accounting for royalty monetization arrangements for the pharmaceutical industry. And for distinguishing liabilities and equity that we'll highlight today and discuss, stakeholders provided feedback on what targeted improvements the board should consider in this area, and if stakeholders would support accounting for more instruments as equity as compared to today. Chapter 3 on the next slide was about broadly about intangibles. There's only 3 topics in this chapter. but addressing the accounting for crypto assets beyond the last project that was issued on crypto, as Rich mentioned, was really the top priority for Chapter 3. And related to this, a research agenda was added after the issuance of the ITC that will look at explore targeted improvements for certain arrangements. For Chapter 4 was kind of other assets and liabilities, so topics that didn't fit neatly into Chapter 1 through 3. And here, asset retirement obligations, or AROs, was a top priority for stakeholders within this chapter, although there was mixed views on this topic. And there was feedback that we received focusing on unrecognized AROs and how and if they should be recorded. The definition of cash equivalents also received a fair amount of feedback in this topic, but received mixed feedback about whether the board should change that definition. For Chapter 5, this related to a few topics related to retirement and other employee benefits. All of the topics in Chapter 5 related to this topic were generally identified as low priorities by stakeholders, although a few of them did say the board should take it on. Chapter 6 was related to income and expenses. This primarily included several revenue-related topics, among others. For this, principal versus agent considerations was the highest priority within the Chapter 6, but stakeholders noted kind of that this area continues to be challenging and did provide some mixed views about whether the board should address it. And the remainder of the topics in Chapter 6 were generally identified as lower priorities. Chapter 7 was related to presentation, disclosure of financial reporting information. This included the topic of enhanced disclosures, which had a list of several disclosures that investors were looking for. And this really related to primarily investor feedback in this chapter. Enhanced disclosures and outdated disclosures were the highest priority for stakeholders within this chapter. And while investors generally agreed that the board should enhance disclosures as a top priority, although they provided a wide variety of suggestions of what disclosures should be enhanced, while on the other hand, preparers generally agreed that the board should not add any incremental disclosures, but rather consider reducing or eliminating outdated disclosures, such as derivatives or fair value measurement disclosures, as a top priority. And then the final chapter, Chapter 8, related to current research agenda projects, and the questions here asked for some direction and paths forward on these topics. This included a consolidation for business entities, and that received mixed views on whether the board should address the topic as a priority, and if so, if they should consider requiring a single consolidation model. And this chapter also included financial key performance indicators and intangibles, which the board has separate invitation to comments for and received additional feedback in those invitation to comments. So on the next slide, I'm not going to go through this slide, but this gives you a broad overview of all the topics. You'll see why we're not staying on this slide, even though it gives you kind of a holistic picture. We included it because we think this gives you the most picture of all the topics, but it's a lot to look at. But this chart demonstrates really the high volume of feedback that was received and the diversity of that feedback. We received a lot of feedback, so this slide reflects that. So feel free to go through in more detail. And so as just kind of a reminder on next steps on the next slide, the staff is in the process of summarizing the feedback for the board and will be presenting to a board meeting this fall. They'll then take that feedback and they'll analyze it against their agenda decision criteria as part of an overall agenda prioritization process and decide how to make changes to the research and the technical agendas. And then we'll issue an agenda consultation report once the board has finished that process to summarize the process overall. And with that, I'll turn it back over to Mike.
Great. Thank you for summarizing a lot of information in a very efficient manner. Any observations or perspectives from,
Sorry, just one quick question may help all of us, I think, in the breakouts. But given the variety of perspectives and topics that we just heard about, how did you go about selecting these four for today's discussion? That might help us kind of frame our perspectives.
I think we tried to have a mix, obviously ones that reflect the volume of feedback that was received, and just thinking that these were areas that we know that have come up over time. In some cases, topics we haven't touched before. Thought it'd be interesting to go into. So, Rich, you want to add?
Yeah, and maybe not on the selection, but more along the lines of don't think those are the only four that you'll get a chance to weigh in on. So think about disclosures, for example, right? We have pretty diametrically opposed views on enhance them, meaning expand them, or rationalize them, right? And what might be a good future discussion with FASAC is more about disclosure effectiveness, right? Because I think even though those sound very different, I think they're really getting at the same thing, is how do you best convey the information? So more chances. The last slide that Erica didn't go through in detail, which had all the colors and you couldn't really read the titles. I think that, you know, some might look at that and be a little disappointed, saying, hey, there's no clear answers, or there's only clear answers on these 5 things, don't touch them, right? I do think as we dig into the material, we get feedback from FASAC, we get feedback from other groups, you'll see that there's more common areas that all of our stakeholders are focused on, right? Some might be more preparer, some might be more investor, but ultimately, as we work through the solutions, so if you thought standard setting was easy, no, it's not. That's our starting point. But I think as we get into the details, some things will become clear for us as a board.
Saul.
On enhanced disclosure, it is, I think the thing that stood out was how many views you had, but also, as you said, Rich, the diametrically opposed views in terms of being a top priority and a low priority. I'm curious just if there's generalizations you can make about who voted for what. Is it that investors see it as a top priority and preparers see it as a low priority? I'm just curious because it would suggest an interesting tension there.
Yeah, so when it came to enhanced disclosures, in the top bucket is mostly investors and investor advocate groups. In the low bucket is preparers and trade groups that represent preparers. I would say one thing about enhanced disclosures, there's if you recall in the ITC, there's a wide variety of topics listed, very similar feedback on a wide variety of topics, plus some more to go in there as well.
Thank you. Any other observations or questions? All right. Well, we've given you a lot to chew on in your breakout sessions, and I'm going to suggest you take a full hour in those sessions. That will still give you some time to have a little break, and we'll reconvene at 11 o'clock just to give us that extra time. For logistics, the breakout groups are private meetings, so not be recorded or live streamed, so those on the audience can rejoin us when we reconvene at 11. Discussion questions are in your documents. The most recent version of assigned groups is provided around the table, both in-person and virtual participants. 2 co-leaders will come back and provide a summary of key takeaways when we reconvene. And after we go offline here, Alicia will give you instructions on how to get to the breakout room. So any questions? If not, we'll close the live stream. And thank you. Okay, welcome back, everyone. To those on the live stream, I apologize that we're a few minutes late getting started here. That reflects the quality of the discussion that we had in the breakouts. Literally, I think many folks in the room didn't get much of a break here, and certainly the discussion leaders didn't get one. So the way the discussion questions were laid out, it started with 2 general questions, but what I'm going to do is suggest we jump right into the individual topics, because I think the relative prioritization might become a little bit more obvious after we have our discussion. But I'll throw those questions open at the end of the session. And I think in particular, I'd be interested in getting the groups thinking about sort of the second sentence of question 1 in terms of what are the challenges or opportunities should the board consider in developing its overall priorities and future standard setting agenda. So that's obviously a very broad question, but I think one that might be interesting to get some perspective from the group that might not come out of the individual pieces that we talk about today. So put your thinking caps on, and I'd really love to get your broader thoughts on that one. So what I'm going to do is go sort of topic by topic, go around the room to the discussion leaders, stagger it a little bit in terms of what group we start with. And I recognize, given all the topics and the relative experiences or lack of experiences of people in the room, you might not have gotten to each topic that I ask about. So if I go to you and ask about something, you say, we really didn't get to that one, just we'll be fine and we'll move on to the next group. So I'll start with Group A on equity. Joe.
Thank you, Mike. So our topic had the most lively discussion around the equity method topic, and I think that reflects the variety of views that came from participants who are both or who are practitioners, preparers, and investors. Overall, given that variety, we would recommend that the board do consider equity method accounting as a future topic. The specific questions about potentially applying 321 accounting to what are currently accounted for as equity method investments was supported by many members of our group. One member mentioned that if the option for electing 321 were made available, that perhaps the board could also consider thinking about a proportionate consolidation model, effectively a fourth option to account for equity method investments. There was some discussion about whether the election should be made available to entities in all industries, particularly some slight concern about industries that already are well versed in equity method accounting and whose investors are well versed in equity method accounting. On the preparer side, there was no talk of discussion about challenges that they're currently facing in applying the 321 alternative measurement model, and they would foresee similarly little challenges in applying that to what are currently accounted for as equity method investments. And then on the investor side, investors were interested in more disclosures, noting that both disclosures under current equity method accounting and 321 measurement alternative are relatively light, except in those circumstances where maybe an SEC registrant has supplemental reporting under Rule 309, where they get a lot of information about significant equity method investees.
Okay, thank you. Tim and Stephen.
Thanks, Mike. Our group was disproportionately larger in the investors that were in the room. So we got actually some topics that weren't one of the four that came up that we can talk about after we address this. But in terms of the equity method, we had good comments from participants in the room around determining whether it was strategic versus non-strategic, and how it should be classified, and whether that would, if it was fundamental or an investment, whether that would mean it should be classified in operating cash flow or 321. There was also some comments around that the SEC has also made some strides to advance this topic as well. In terms of 321, there was pretty much wide consensus that it's hard to implement in practice, as you need observable transactions to get the mark to fair value. And then determining the time frame of that mark also added to complications as to whether it was when you actually add it in. And extending the life of actually makes it harder to do as well. I don't know what if I...
No, I think the other thing to add on that, Tim, was we heard also, is there an evidence of this thing of significant influence, and how to prove that, and even questions about, when we look at 321 in equity accounting, you have this, I would say this phase. Think about how we think about as we think about the investment. There's bright lines. There's a 20%, and then you have consolidations. And as one participant says, like, it's the same investment, but as soon as I go over that 20%, I'm going to do different accounting. But yet it's the same investment. So is there a reason? Does 321 make sense to have for all of equity as a view? But on the other hand, devil's advocate, we heard, well, depends, right? The fair value in some of these investments could be very difficult, particularly if it's like I could see in life sciences, a biologic, very difficult to fair value something that's unapproved, that's 5 years away, but yet there's an equity investment out there. So I could see both sides of that equation, but again, it was just a fundamental question that came up to think about, those bright lines as we think about it. And then I guess the question also on private equity we heard as well. I don't know from Shripad on private equity, and how does that play into what we've seen with equity method accounting?
So, Tim, maybe I have a question. You mentioned strategic versus non-strategic. Did you have any conversations about how you might make that determination? So thinking back to that Supreme Court line, you know it when you see it, I guess.
Mike, thank you. Great question. And I may actually ask Dan for his thoughts on that as well. He gave a great example there.
Down here, Tim.
Oh, Dan, sorry.
So it's about 20 years old, but the as you probably well know, that for public companies, the SEC prescribes the income statement presentation for commercial entities. An equity method is presented outside of operating income. But if you conclude that it is integral to your operations, you can present it above the line on operating income. Now, it's been 20 years, I think, since anybody talked about it, and it was a pretty high bar. But if there was coordination between the two sort of bodies of guidance, it wouldn't be so much a free option, but it would be a facts and circumstances, maybe investment or entity or whatever, that would say, if it is important to you, then, and your investors, I think somebody mentioned your investors are used to seeing equity method investments is how they think of it. Well, then presumably it would go up in operating income. And that's how the two would come together, that you would say, if it's a part of your operations, then equity method makes sense. It's a one-line consolidation. And then if it's not, and it's presented below operating income, then maybe a 321 or a fair value would be a more intuitive model, because you're saying it's not a part of my operations. It is more of an investment per se. So that's the combination of those two things, which was integral under the way the SEC talked about it, and then strategic in here. Maybe there'd be a new term, but it felt like they were tugging at the same thing.
Great. Okay. Thank you. Debbie and Greg.
Yeah, thanks, Mike. We had a pretty lively discussion once the group got going. So it sounds like everybody else did. A lot of differing viewpoints from the different constituencies that we had in the room. From an investor viewpoint, they think there is a decision useful information that's provided today for the equity method investments. And there are some concerns that more options could lead to less comparability. That was a topic of conversation, was comparability. Generally, they think the equity method should stay, especially for significant equity method investments, but an option may be helpful for non-strategic investments. So that strategic versus non-strategic viewpoint was also shared in our group. The availability of the information can be challenging in applying the equity method. The fair value option is not frequently elected today because the information is not available, because there are private investments that can be hard to measure. So a lot of differing viewpoints. James May had a pretty interesting preparer perspective that if I can call on James to comment.
Sure. Thanks, Greg. The strategic versus non-strategic, I think, kind of resonates with the comments I was making in the breakout. Was, we as an infrastructure company have a lot of partnerships, joint ventures, but we also have other investments in companies that are not public companies, and trying to gather information from smaller non-public companies on a regular basis to give decision useful information for disclosure, for recognition purposes, isn't necessarily that easy. And maybe just one additional sort of wrinkle to the conversation here is that strategic versus non-strategic. Maybe there's a path of scoping, making the bar higher in terms of scoping things into the equity method of accounting instead of where it is now. We find ourselves sometimes thinking about, should we really be applying equity method accounting, even though the accounting's telling us to do that, given that the information we get and the necessary, the influence we might have over that company isn't as significant as maybe the accounting results are. So for a company that has several of these, and some that are very strategic and the exact same technology that we employ and consolidate into our financials, we apply one line consolidation, versus some others that are, different or tangential, maybe construction companies or other things like that we have investments in, are very different from a user standpoint, I would believe.
Thank you. Okay. A lot to chew on as it relates to the equity method, maybe not surprising. Why do we move on to consolidation? And Stephen and Tim, we'll start with you this time. They're in deep consultation over there.
Thanks, Mike. So around consolidation, yeah, I think generally the group thought that things here weren't in dire need of a readjustment. Minor adjustments, and certainly not in dire need of a total redo. In general, the group thought that we were getting to the right answers. Certainly still some here around VIEs, and that some companies had found ways to get around it, and some technical improvements that could be done to make them more waterproof. There was a suggestion of a single control model that might help, but some concerns around the cost of implementing that. I don't know if Adam, do you want to comment on that? Thanks.
Sure. Yeah. The idea around a single model was rather than a complete rewrite, maybe adopt the power and economics that exist in 810 today, with whatever, potential tweaks would come out of that, but that the costs seem to be mostly around whether an entity qualified as a VIE, so the status assessment felt a little disproportionate to figure out, which fork in the road do I take, but the power and economics seem to fit a pretty wide variety of fact patterns, and so that might be one potential path where you could avoid the status assessment and just apply, that control model a little more generally.
And maybe might just add some other color commentary. What we also heard, was seemed to be like big plays seem to understand the consolidation model. It was what we heard. It seems where it seems to kind of get maybe, I would say, gray matter is when we come the small players in partnerships and try to understand how to apply the model. And does it make sense to make tweaks to the consolidation model, and will that cost benefit make sense? Because I think for the larger players, it's understood, controls understood, and this whole thing of what we said is, I guess, the power, economics, and control. Big players seem to understand that and how to apply it. It seems like the small players have more difficult time doing it. And I know Dan was pretty adamant. He said, Steve, if we make a tweak to this, it's going to cost us a lot of money to do. So we that's kind of how we ended our session just with that point. So I don't know, Dan, if you want to add any final thoughts on that.
Yeah, maybe the only, I don't know, the tweaks would, but if you went to a single model, at least what made me think about was 606 and how for many industries, not much changed, but it was a pretty significant lift. And so if you went to a single model, if you change any of the words, we'd probably have to go through legal entity by legal entity, and it could get to a whole lot of work for, but largely gets to a good answer. And I think after 606, we say this is fantastic. We got a single standard and it covers all. But it was a lot of work to do for not much change.
Okay, great. Let's move on to Debbie and Greg.
Great, thank you. Well, we had very similar themes to what Group B did, that generally speaking, the current guidance gets you to the right answer. But there's quite a lot of complexities within that, mainly in the VIE model. And, so we had, some discussion as to what the decision usefulness information is in the disclosures, and specifically, how helpful or lack thereof that is to investors. So I was going to ask Todd if he can give us a few comments related to that.
Sure. I think this actually has like a nice Venn diagram between some of the other colorful rows on the chart. Enhancing disclosures, limiting disclosures. This is one, I've been doing this for almost 20 years. I think I can count on one finger how many questions I've got asked on VIEs. And I married a preparer, so I know the level of effort that's involved with producing this. So it could be an area where maybe you don't change the models, or maybe, I'm probably not in the jurisdiction to say 1 versus 2. But I do think the output of that model could be more efficient, more effective.
Yeah, so thank you.
Great. I know, Brandon, go ahead.
Yeah, so the starting point is our group didn't spend a single second on consolidation. It's the one topic we did not get to. But I'll share just a couple thoughts, which I think were good points by those in the room, and Dan's point on cost. I think we spent a lot of time thinking about that. And I think what I'm hearing, at least how I've thought about this, is there's a long-term cost, like a cost for the next 50 years of having two models, very complex. The company that has one transaction that's transformative and they get into this guidance and they don't understand why I'm doing this VIE thing. And there's a disconnect maybe in why you're a VIE and how you're doing the analysis versus the short-term cost, which is companies that are used to this, that have lots of legal entities they've already analyzed, and putting a new standard through that. And I think that needs to be weighed. The other thing I would say is, I do think 95% of the time, maybe more, you're getting to the answer that makes the most sense. But as a practitioner, I see those 5%, and I see companies saying, I want to be a VIE because I like the result, or I like the related party rules. I want to do a tiebreaker. I know I don't control, but if I can be related to the other party, now I might be able to consolidate and put them on. And those are the ones, as a practitioner, I get concerned about, of having a single model that's conceptual, that will stand the test of time, would be better over time than to continue to have the two models.
Mike, just some colored commentary. I know this didn't come up in our session, and I was going to bring it forward, but I know for a preparer perspective, I do know that big companies really don't like a VIE in their consolidation for a number of reasons. One, they cannot enforce their policies on a VIE. The VIE can do anything they want. They can go out and issue debt with really no control. So from a preparer perspective, and I just know talking to a lot of preparers, they go, Steve, this is like a black flag. We don't even want to get involved in that. We rather just buy the company. Because to me, to your point, I'll just buy it. Why deal with the VIE model and have an entity that's in my consolidation that I can't enforce my policy, and they can go out and do things in the market that I have no control over? So I'm just giving you the practical reasons on why, companies stay away from it. At least for big players. And to your point on costs, I would just buy it. There's too much risk for keeping it.
Okay. Let's move on to AROs, and we're going to start with Team C this time. So Greg and Debbie.
Yeah, thanks, Mike. On the topic of AROs, kind of a very specific industry situation. So we didn't have the broadest discussion regarding that. The group didn't think it was the highest priority, as investors see this less frequently. It'd be a challenge to recognize fair value, maybe more disclosures around those that are unrecognized were some of the topics that were discussed. I was again going to call on James to provide his viewpoint. Wearing you out, James, sorry.
Sure, the infrastructure guy has to talk about AROs. Yeah, no, we definitely run across this in the industry from time to time. It comes up when you've got, indefinite life, or an easement that's got an indefinite life on it, and you've got transmission lines, as an example, that sit on it. So it definitely comes up. I believe there are already qualitative disclosures that exist when you have that circumstance. It's an area that maybe to look at for disclosure. We talked a bit about recognition. I think, at least my view is recognition for something where you don't know when that obligation is going to get settled will get really complicated really quick, versus, hey, if I had to take this, transmission line out of service today, here's how much it would cost. Might be a good compromise if that's something that investors are interested in. Now, I don't know how interesting that is to investors if that transmission line's got a 100-year life and it's 100 years from now that you would have that obligation. But it's definitely something that happens with large infrastructure companies, and especially companies that operate utilities, or I imagine fiber companies and the sort would also run across this as well.
Thank you. Anything else? Good. Joe, Brian.
Thanks, Mike. So our team also agreed that this probably isn't a topic that needs to get onto the board's agenda, but if it does, we think that the addressing or resolving potentially the recognition piece first, where you have some unrecognized, effectively don't get accounted for versus recognized AROs. Potentially addressing that would be the higher priority of that versus the current measurement model.
Great. All right, let's move on to distinguishing. Oh, wait a minute. I missed someone. Oh, I didn't get Stephen and Tim. Sorry.
Our group was similar to the other groups, with AROs probably fallen in the lower half of the priority box. But there were some investors that felt passionate, mostly around active versus inactive AROs and being able to distinguish the difference there. These are extremely long, and so for investors, it's awfully hard to see what the cash flows will be. Most of the folks in the group felt this could be remedied in better disclosures as opposed to wholesale changes. Deanne had asked if this might be an industry-specific topic, given that these assets tend to exist especially in specific industries. And then for preparers, some issue between having the fair value being an internal remediation versus an external remediation, and how that may lead to differences in gains when it's settled. And also some jurisdictional differences that also could play a role. So, yeah.
And maybe one other point that was mentioned, the calculation of the ARO, I think was one participant, I think it was Tom, mentioned the credit risk rate to use. I thought that was interesting versus a risk-free rate. And that was, again, and that could be different obligations based on the company's credit risk. So we thought that maybe that'd be maybe an adjustment or a tweak to how the ARO is calculated. So, so if a company's in bankruptcy versus a company that's not, that's going to be a very different obligation.
Okay. Thank you. All right. The last topic, distinguishing liabilities from equity. I'll turn it to Brandon.
Yeah, I mean, our group had a good discussion about this issue and talked a little bit about the graph that was shown earlier by the FASB staff on, many said it was a high priority, but there was a fair amount that said it was a low priority. And we were speculating a little bit of maybe those low priority are more concerned what the FASB might do with the project versus, will it get worse or will it actually get better? We talked a little bit about what does simplification mean in this area of liabilities and equity. Does simplification just mean, make it less likely that companies will get it wrong? We observed that a lot of companies that are finding themselves in the analysis are pre-revenue companies, pre-IPO companies that then go public. They might not have as much sophistication from an accounting perspective in analyzing these very nuanced agreements and provisions. And so does simplification mean just making it easier to get it right? And then we talked a little bit about investors, like how do investors use the information? What's important to investors? Do they really care about the mark to market of an instrument that will be settled in a company's shares, but happens to have a provision that runs afoul of some very specific indexation guidance and some counterintuitive mark to market? And the investors in our breakout observed that they back that out. And we see that a lot of times when there has been liability and equity restatements in which investors shrug their shoulders. It doesn't impact the stock. It doesn't impact how investors are viewing the propositions of the company. So overall, we thought this should be a project that the FASB takes on as a high priority, and really think about from the investor angle, what does it mean to be equity versus liability? And then finally, one point I forgot is we talked a little bit about, is classification important, like calling it a liability, or is it really the income statement that should be the main concern, and does the mark to market of the liability make the most sense?
Thank you. Stephen and Tim.
Thank you, Mike. There was a run-in joke in our group that this was so complex that there were probably 20 preparers in the country that actually knew how to do this correctly, that were experts in it.
Thank God they're all in this room.
So certainly we our group spent a lot of time talking about the large complexity of the issue. It's certainly in need of simplification. We did talk about some quick wins with some technical improvements with indexation sort of leading the charge there. But yeah, a lot of thoughts around how costly this is. And I think there was a quote here, silly accounting, as no one really cares about the adjustments. What else did I miss?
Again, I think the view also was, when we think about the rules, what are we looking for? And I kind of said this at another meeting, precision versus, getting, to the buckets. And I guess what we heard, at least from one participant, like, we do volatility. We do this hedging portfolio in order to offset this volatility. And yet we're down to lots of cost and complexity to divide these little buckets up to the right hedges. So we're down to a transaction level, and to do the matching and the time and effort to do, individual pieces or buckets or whatever they need to do to kind of match those elements. And the question is, if the view is that we're doing this portfolio view, and that's the view, then no one's trying to game the system. They're trying to come up with a portfolio to offset that volatility. And the question is a lot of time and effort to do that. And then that we heard is, does that really get reflected properly in the financial statements? Is it really helping investors better understand what is going on as those derivatives change? And they try to offset. Is that really telling the whole story? And then what we heard is, well, when they do go into the financials, are you now getting, you're not talking about operational challenges, you're talking about something that's not related to the operations of the company. You have FX going through the company, it has nothing to do with going on with the operations of the efficiency of the company. So you get a mixed message in trying to really distinguish for the investors what's really going on. And it gets kind of lost in the sauce a bit. So I don't know. I know John Bull talked about that a little bit, but that's kind of we want financial reporting to reflect some of that and kind of separate that from what's going on in the business.
Great. Debbie and Greg.
Yeah, thanks, Mike. So the sentiment in our group was that this, is not as high a priority item as maybe some of the other ones that we talked about, or some of the ones that we haven't talked about, that especially from the preparer's standpoint, the applicability of this is small. It's seen more in private companies than the public companies that were represented in our room. And I think additionally, we consistently heard that some of the improvements that the FASB has made in this area, specifically on convertible instruments, has helped simplify it. Hearing the other folks' perspectives agree, and definitely the part that Brandon mentioned about if you have a particular transaction that settles in cash versus stock, how to handle that. I mean, I've seen that complexity, but I thought, given this one was shown to be a higher priority from a practitioner standpoint, it would be interesting to hear Jeremy's perspective on that.
Yeah, thank you. I just made a kind of a high-level observation to the group that I do believe that the recent improvements to the guides of this area has been well received, primarily from our public companies. Albeit it's still a complex area, we see fewer and fewer questions from our public entities with regards to the equity and liabilities. We do see still a fair amount with the private companies, especially, and I think I agree with everything that Brandon said, in situations in pre-IPO with a private company going to public, where they're going back, looking at all these various instruments, and maybe coming to some different conclusions that they may have otherwise had previously. So I would just encourage us to continue to make progress, improvements, and to continue to look for ways to simplify. But I will say that some of the improvements we made over the last several years has been very helpful.
Okay. Tim and Stephen, I know you said there were maybe some other things you had a chance to touch on. You were an overachieving group there. Anything you'd like to add? And similarly, if the other team members want to reflect, if there's things they'd like to add.
Yeah. So Stephen and I were surprised because we thought we were going to focus on the four main topics, and our group pretty quickly said there's another priority here, which was around hedging. Who was it?
That was John Bull.
Yeah. I'm actually going to ask John if he'd be willing to give his thoughts there.
Sure, happy to. So, hedge accounting obviously came up as one of the topics that folks had a lot of interest in. I think it was pertinent to bring it up because it's an important topic for financial institutions and all institutions for that matter, but mostly for banks. There's the notion of the fact that you use hedge accounting or derivatives as part of your risk management, especially in banking and mostly interest rate risk. And the hedge accounting construct today does not lend itself to the ability to look at your interest rate position as a company, which is how we manage risk. And so we talked about dynamic, hedging, which might be a topic that takes a while to get to, given the work that the IASB is doing there it's been going on for some time. But in terms of targeted improvement, one of the topics we talked about was updating some of the criteria to allow the ability to hedge HTM securities. The fact that they accounted for as based on amortized cost it's important, but we do disclose the fair value of HTM securities, the unrealized losses, and it would be like hedging an HFI loan portfolio. So we talked about that, but that's one that I would strongly recommend that we consider.
I know the board has received a lot of feedback about hedges, so I suspect they'll continue to explore that area. Anything else in terms of the topics we discussed before we go to that broader view that I asked you all to reflect on in terms of challenges and opportunities?
Yep.
David.
Thanks, Mike. I'm curious, we didn't talk about this in our group at length at least, but with respect to the 4 areas that we are talking about, is there anything about those areas that drives, for a preparer, drives non-GAAP reporting? So you've got you're following GAAP and then you do your non-GAAP reporting to unwind it or cast it differently. And likewise for investors where you might unwind transactions or things. So you're looking at the accounting differently.
Great question. Any thoughts on that? Debbie?
Yeah, Mike, our group too had some additional topics that they thought were high priorities, echoing derivatives and hedging. The other was principal versus agent and that determination from 606. And then we also talked a little bit about business versus asset guidance, especially the fair value of contingent consideration. So those were some additional areas.
Thank you. Any, who else do I have? Stephen.
Yeah, Dave, I think to answer your question about non-GAAP, I do know some companies today are non-GAAPing the changes in equity method accounting. I know they're doing that. And so, but even at 321, they don't like the answer of going through the P&L also, because again, these are non-cash P&L items, and they also want to back that out. Again, for the same reason, as much as we talk about fair value, and I think we talked about this in our room, the cost of fair value, it's a point in time, but should that be something that needs to go to the financials? By the time the 10K is filed, it's already, the fair value has already changed, and the answer could be very different. So the question is, companies believe if it's not strategic to the company, I just non-GAAP it because my investor who's following me is getting this P&L hit. It has nothing to do with the business. So especially when it comes to investments.
Rich and then Shripad.
Yeah, Mike, I thought I heard in our group when we talked about liabilities and equity that equity investors will undo the fair value adjustments related to liabilities. And that one of the reasons they were okay with maybe not changing was because they could undo the accounting, which was a real big endorsement for the accounting to begin with.
back to the point.
Yes, Shripad.
Yeah, I think I mentioned this in the group, and Steve may have touched upon it, and somebody else brought up proportionate consolidation as well. But something that's really happening almost every single day today, these private credit transactions, they're going into joint ventures, and for accounting purposes, it achieves full consolidation in most cases. So there's a minority interest on a fully consolidated basis. But when you actually just peel the onion and you look at the features and the underlying economics of these are truly, equal governance and a joint ownership of assets and liabilities at that JV with proportionate cash distribution. So it's truly like a JV, not a fully consolidated subsidiary or even equity accounting. So at least in most of these cases, we are reversing that full consolidation and going towards proportionate consolidation, which I know is very limited on the literature, but I think that is something which should be looked into a little bit more. I know somebody mentioned it right at the beginning, but that is an important element, especially in today's market with transactions.
It's a lot of work to unwind that, I'm sure. Any other observations? Yep.
Just briefly on the topic of equity method accounting, in the event the board in some sense retains and adjusts that model, there's a fair amount of cost in basis differences, dilution gains, right? The details around equity method accounting. And I think that would be a question to suss out to say even if there's a strategic investor sort of perspective that says we need the model, some of those details I'm not sure result in a whole lot of useful information. So there may be some tweaks in that sort of scenario where it's retained.
Yeah, definitely. Anyone else? Well, let's first off, thanks for I think the range of input that we've gotten as these breakouts and the different areas that everyone focused on probably gets back to Rich's point earlier about the challenges of standard setting, right? A lot of interesting views, a lot of different things to attack. So it'll be interesting to see how this goes forward. And special thanks to the group leaders this time around. That was a jam-packed session that you had to pull together a lot. So I really appreciate each of the team leaders doing that. So throw it open to the broader discussion. Is there anything you'd like to comment in terms of, broadly what the challenges and opportunities will be for the staff and the board as they move forward with the agenda consultation? Brendan?
Yeah, maybe just a general question for the board. I know in our letter and I think in others that I've read, there was questions about are these high priority projects, and then some comments of maybe yes, no, maybe, but maybe you should send this to the EITF. So currently the EITF takes agenda requests directly to them and they consider adding it. I wonder how the FASB is going to think about maybe those little nuggets in those comment letters about smaller scale projects that the EITF could potentially work on.
Mm-hmm. Yeah, so it's the interesting point. How big do you go on trying to solve some of these problems, and where's the right place to do it? So, is this a follow-up, Hillary? Or
Yeah,
yes.
I think a follow-up to Brandon. Brandon, I think it's a great point. So I know that was the feedback is coming back to the board. I believe that the feedback is also going to be kind of tailored of, is there certain areas of feedback that would be good opportunities for the EITF to take on, things that would meet the EITF agenda criteria? So certainly I think that's part of what the staff is thinking about when pulling together that feedback, and will be given to the board for consideration as well. So good point.
Yeah, I think that's fantastic. Deanne.
This might be a little bit of a statement of the obvious, but the areas where there are dramatic, big differences in low versus high, like that's going to be tough to navigate, because is it a low priority or is it a no priority? And then I couldn't really completely assess neutrality. But I think an opportunity, and what's been really successful, I think thus far is those to the extent you can do tweaks to existing standards that clarify or simplify or whatever in the short term,
and maybe address something bigger, longer term. I mean, and kind of stage it that way. That might feel a little, to me, a little bit like double work, like maybe just take on the whole thing, except for making progress and demonstrating quick hits, I think is very valuable.
Thank you. Dan.
Maybe another way to look at slide 5 is a bit of a play on silence is assent, meaning if you sorted it based on the least amount of lows, you might find a more practical way through what you can get accomplished, because you'd have pros and neutrals. Again, you speak silence, neutral is assent, and then the least amount of objections. So that's maybe, you're probably looking at it a million ways, but that was one that occurred to me as you went through slide 5.
That's an interesting way of looking at it. Anyone, Joe?
I would maybe offer that some of the more significant standards released recently have been in the area of disclosures that I think are intended to address investor feedback. And so maybe I would ask that in future prioritization, in light of the discussions we had today, plus the invitation to comment, that the future projects balance some requests from investors, as well as some requests from preparers, as well as some requests for practitioners. So everyone gets a little bit that's being worked on for their own pet projects.
Everyone gets a little something. I like that. Anyone else? I might, if there's not, I might just end by saying it's sort of, I think, interesting how many topics were on that list, right? And I actually see that as a big plus. I think it reflects a couple of things. I think it reflects all of the requests the staff and the board have done from input from different sources, and they're being active in the community to encourage people to come forward. And, you know, quite frankly, I believe they come forward with the belief that the board is going to do their best to do something about these, right? And I don't think anyone ever expects they're going to get everything they want, but they do, I think, appreciate all the work that the board's done of late, especially in the last few years. There's been so much effort to address things that were high the last time on the agenda consult. So the fact that people are coming back with more, yeah, I take that as a plus. Stephen.
Yeah, and Mike, maybe to kind of close it up with you a little bit on this is, accounting is not static. I think as we think about, I started 40 years ago, and here I am now sitting at the FASB doing this. How much has changed? And more to change, right? So the view has to be is that we need to continue to look forward. We need to continue to always evolve, because rules are going to change, because business is going to change. And the question here is, when the business economics don't make sense to what we're reporting, the rule has to change in order to reflect what we're doing. And it's going to change. I mean, AI is going to change everything again. So in 10 years from now, we'll be talking a different tune. So hopefully, we have a body here that could be agile and evolve as time changes.
Just make sure your grandchild studies accounting, and they'll be here. Okay, well, thank you, everyone. And again, thanks for the team leaders especially. So speaking, Stephen just led right into AI, and the next topic is technology. Rich and I were reflecting today that, at least in our time, maybe this is the 7th time we've tried to tackle technology as part of FASAC. And the challenge is, and has always been, how do we make it relevant to the standard setting process? And what would our suggestions be? Thanks, team. I'm sorry, I should have said thanks to the agenda consult team there. But what should they be doing now about technology, right? So I think we all see the pace of technological change in various ways in our professional lives and our personal lives. And the goal is to sort of project a little bit, how does that impact standard setting as we go forward? And specifically, what's next for the board, or what should the board be considering? So that's what we're going to discuss in the breakouts, but I just really ask you to keep that in mind, right? The whole concept of what next for the board and the staff. So with that, I think we can break, and we'll give you just directions for the breakout sessions. Welcome back, everyone. We're going to resume our conversation about technology. I think we all agreed, at least in my group, that technology is in fact a thing. And so now we need to figure out exactly what that thing is and what it might mean. I think we have a series of questions here. I presume most of the groups were similar to my group, that we wandered around in various directions. So what I'm going to suggest is, rather than going question by question on a rotation basis, I'll go to each of the team leaders and they could summarize the entire result of their conversation. And so I will start with Jeremy and Monica.
I'll remember to put my microphone on here. So yeah, we had a really robust and great discussion in terms of question one, whether there's anything sort of outdated or has AI or the adoption of any technology rendered any particular piece of guidance obsolete or irrelevant. There were some comments and discussion on accounting for acquisitions and the impact on adoption of AI and technology has had on sort of application of that standard. And the driver there is the types of assets that are being acquired in a particular transaction, and that to the extent large portions of the acquisition are related to technology or AI, how to account for those, how to value those. There were also some comments about ASC 606 and some kinks based on cloud-based versus on-premise issues, and an observation that whether transactions that are similar in substance but get different treatment based on that question on-premise versus cloud doesn't seem to make a lot of sense. But overall, the consensus seemed to be that adoption of AI or technology is really not going to render any particular standard or guidance obsolete at all. I thought I would turn it over to perhaps Yanni or Saul to share some of their observations.
I guess I'll start by default. I don't know how helpful this will be, but I'll just give a perspective on from an analyst perspective, how we're using AI and how it's impacting what at least what I do. So I mean, I was talking to Tim at lunch, and he framed AI in terms of thinking about it in terms of efficiency and insights. And I think it's helpful for both, perhaps more helpful for efficiency at this point, but clearly we're using it a lot to synthesize vast amounts of information, financial information, but also commentary at conferences and whatnot. And it helps you gather a lot of information from numerous sources, transcripts, financial disclosures, Qs, Ks, and summarize it as it relates to certain topics, whether it's outlooks or certain industry topics. Where I think it's gotten more interesting though is in where we've used it more is and where it may help not only efficiency but helping generate more insights, is to use it, is that you're using it more as you would use ChatGPT. And they're really good tools. So asking it questions you want answered that will help you understand and draw insights from vast amounts of information. And stable coins, for example, just to give an example, because this is actually an example where I had to get smarter on something I didn't know a heck of a lot about really quickly. And it's pretty remarkable. Some of the in my view, like some of the quality of information and insights that is giving you. So for example, and obviously you have to ask the question the right way. Can you summarize what all of these banks are saying about the use cases, risk to business models, and how it's informing your strategy, for example, and it pulls from not only financial disclosures, but media commentary, industry reports, in a way that really does help you understand and frame a topic, in a way that maybe you hadn't thought of. And you can also, keep going with that what are the counter arguments that are made by proponents? It helps obviously with efficiency, because going through all this information that it summarizes for you with the relevant, sources that you can go through very quickly, that would take an inordinate amount of time, right? But it also helps get you, if you're using it correctly, it helps get you to a conclusion much more quickly on things. So it's it's getting better and better. Like even a couple months ago, when I did this, it'd give me some answer. And now, if you're using it, and again, I use it like I would use ChatGPT when I'm thinking about, okay, what are, some personal issue or some health issue or something like that. And framing it and using it in the context of the work that you do to try to draw conclusions and understand topics that are sometimes very complicated, that's really where, I think it's been really helpful for me, at least in terms of, doing the work that I do.
I'll just add, as it relates to accounting disclosures and financial statements, I think both professional and individual investors increasingly are using AI overlays on the financial statements themselves to be able to digest, summarize in the same way. And to the extent that accounting disclosures have become longer and more technical over time, I think AI tools are actually a counter to that, because they make the document more accessible to people who might even be less familiar with the accounting technicalities, through summarization, through, how does company X recognize revenue, and getting a plain language answer that is drawn from the disclosures and maybe some figures. And so I think in some ways, we're at the very beginning of these kinds of tools, but I think they'll have the effect of making financial statements and accounting disclosures ultimately much more usable, and will probably increase the consumption of this information, which I think is positive.
Anything else from your team, Monica?
Yeah,
Jeremy?
that was a good summary.
Okay. Then we'll turn it over to Ashley and Jan, and I don't know if and Matt as well. Sorry.
I guess just to be complete, to kind of keep the conversation alive, in 1C, we talked about investor use of AI. I don't want to be repetitive. We can do that as we get the discussion going. But from a preparer perspective, we are definitely seeing faster turnaround, richer questions from investors as they use these tools. So it's putting that healthy pressure back on the preparers to be responsive. And I think we're also seeing a little bit of a different level of pacing across prioritizations for companies of where to invest AI dollars, right? As an investor, their core business model is insights from data. At P&G, our core business model is understanding shopping, excellence in media. So I'm competing against a broader set of investment demands, right, to get AI into financial reporting, right? And so I do worry at a general level, generalizations are dangerous, that there's going to be a little bit of outpacing of investor capability versus companies who have other AI use cases that they're also prioritizing or considering, and how to sequence that out.
I know in our group, and I think it was Ashley actually, I thought she used a great phrase. I don't know if you want to comment on it. Sources of truth.
Thank you. As an investor, I think we definitely would agree with the pace of adoption of AI, and the fact that, not only ourselves, but many of the managers that we employ are increasingly looking for more and more data. So one of the challenges, I think, is as we are looking for more information, what is the predominance of the financial statement, especially the audited financial statement? That is just going to be one part of a lot of information that's going to be fed into models that we're looking for. And it's a little unclear if this is just one of the many sources of information. And I did use an example of, many of us are using non-financial data, non-traditional data, like satellite imagery of shopping centers to track traffic. That can be done on almost a real-time basis at this point. So as we are combining all the different types of information, what is it that we are going to use it for, and what is the role of audited financial statements in that? We did talk about the sources of truth. I'm going to start to, we're going to have an increasing ability to compare across industries, across companies. And so we talked about the need for more comparability. And for these models themselves to, it isn't so much about the prompt that you are putting in. No great answers yet, but the pace of change and what people are looking for is just going to ultimately demand more and more information. And how we try to figure out the best source of truth versus all the different inputs that can go into the model, I think is going to be it's going to be a very open question. Happy to comment on anything else, but I think that reflected a bit of the variety of information we're expecting to have coming through.
Yeah. I thought the other thing that I thought was interesting in our group, it's always dangerous having me in your group, so I apologize to you too, is Rich was sharing with us some of the work, and Nellie, some of the work that the staff is doing to analyze their own statements and put them through language models and see what that means. And I said probably early stages of experimentation, but I don't know if you want to share a little bit about that, because I thought it was really interesting what it was you're up to there and what the goal is.
Yeah, so it's probably more near term and then a little down the road. So currently we do have pilots with different AI tools that we have some teams exploring. That's really how we do our work. But one of the things that we've budgeted for and that we're going to work on rolling out is a AI search and tool to use over the COD for internal use. Part of that, one of the reasons that we're doing that internal only is the COD is the authoritative literature, and to put something over the top of it that's endorsed by us may cause some confusion about what's really authoritative. But we do think it's important for us to try that, see what the output could be. One of the things that I'm looking forward to is, will it maybe help us with how we write the COD in the future to make it better? Recognizing others are going to be using those tools to go through the COD. So that's kind of the near term projects.
I thought that was a great idea. Todd and Stephen. Oh, Jan. Yep.
I thought there's one other aspect of our group discussion would be interesting in this discussion. So when we talk about increased comparability, it ties into this morning's conversation when we're asking for more optionality in standard setting, whether over long term, the use of model and the use of massive data will actually reduce the optionality that we currently embedded in standard setting, whether it's going to change it towards more of a just one size or one standard fits all, just so we have more data-driven analysis coming, demand from the user group. So.
Great, thank you. Anything else from your team? Thank you very much. If not, Todd and Stephen.
All right. I apologize. This whole topic was my idea. So I'm gonna go get on that helicopter. My last day here. I would just echo kind of what others have said on the investor side. I do think it's important. I think the rate of change might be a little bit, well, it definitely seems to be at a faster pace than perhaps preparers and auditors, but I still think it's important. So I'm glad we made the time to talk about this. Just in my, not to over summarize the remarks already made, but we are able to process information so much faster. So I do think if I'm thinking standard setting and the input you're going to get from investors is going to skew more towards I can do a lot more, right, with these power tools. Now there's some costs to that, right? And I think that's what we need to think about. So I'll reuse the analogy I used this morning that I borrowed. It's kind of like a F1 racing car. So you have the chips and the GPUs, which is the car, and then you have the driver he needs to be able to drive that. So if you put as I use my 11-year-old daughter, you're going to run into the wall pretty quick. And then it's the data, right? And so I think that's actually the most important. I didn't realize F1. The tires are the data, and that's how you win the races, right? And organizations are at various stages of how to use that data. What I found interesting in our research is regulated industries are able to use AI tools to more benefits quicker because they've been putting controls on that data. And I think we had that conversation in our room as well. I think that's investors and preparers is we're probably early in that journey of being able to control that data. So you just don't want to give your data like away. I think is some of the comments that are made. You need to be able to control that and have, so it's early days, but the technology is moving quick. So it's kind of a give or take. One of the other things I think in terms that we have experienced, in terms of a standard setting and cost perspective is XBRL as an example where I think we have less reliance on that over time because some of these tools are able to get to that information more efficiently in some regards. So that's something I think, in terms of a standard setting approach, we should maybe think about in the future.
And just to add on, our conversation covered many of the same points that have already been expressed. And so I want to kind of focus on one specific area related to what insights or takeaways could a standard setter get from this conversation about technology. And we had a few ideas. The first is, obviously this shifts the cost benefit considerations in standard setting. So there is a lower cost to produce information through the use of technology, greater benefits to users because their cost of processing becomes lower. And so that could kind of tilt toward possibly more disclosure. A second consideration would be the speed and efficiency of financial reporting is changing. So more can be done quickly, which could have implications for example, the effective date in transitioning to a new standard or even financial reporting timelines. We also discussed that despite alternative sources of information and alternative data coming in, there's still a need for audited financial statements and the information they provide, and even if nothing else, as a kind of a reality check compared to the other sources of information that is coming in on a more frequent basis. We also kind of our conversation touched on the idea that information overload may not be as much of a thing as it used to be, and that investors could benefit from granular data that they could process and use however they see fit. So that could mean additional disclosures. It could mean more disaggregation in recognized numbers in the financial statements because their ability to work with those has increased. Another point of discussion is that there may be a leveling of the playing field between what have been historically more sophisticated investors or users and historically less sophisticated users. And that means that disclosures that are more complex, more technical in nature could be absorbed and processed by a wider range of financial statement users than has been able to do so in the past. We also talked about differences where this isn't, not all preparers have the same ability to leverage technology. So larger companies will be able to do more sooner. There's even a kind of a point made that certain regulated companies may have advantages over unregulated companies based on the data that they have available. And then a final point would be a takeaway it's related to the discussion this morning with outreach to various stakeholders about possible standard setting topics and how technology and AI can be used to gather information beyond surveys and comment letters to see where the major issues relies. And just as one example, so an analysis could be done of conference calls with investors and what types of questions are most frequent and most common. And so where are investors stumbling in reading and interpreting financial statements, and that data could be gathered in a way that would have been difficult to do just a few years ago.
That was a great summary, Stephen. I'll probe a little bit sorry, there's a question and no, it's okay. Go ahead.
I just wanted to maybe clarify a point is I think when I think about it, I think in three buckets. One is the preparation of the financial statements. Second is the audit of them. And then the third is the consumption. And I think it's important to think about what you're solving for in each of those steps and realize what AI can do. Because if someone says, hey, we're so far ahead on the investor side, well, there's a different problem you were solving for, right? The digestion of information that was already tagged and presented in a way versus when you're preparing it. We have had data lakes and automation and a lot of technology, but to go in and pull the right information and contextualize it, that's really the problem we're trying to solve for. And so AI, I think will help us, but you still have to figure out how to tag it and then make sure that you're getting it controlled and you're getting accurate results from that. And so I think that's probably what we're struggling with a bit, is just making sure that there's, as I say, a shared understanding of what problem we're trying to solve for, and that you could, I think we're further ahead from a consumption perspective than we are with, I would say, data extraction.
So, Stephen, I'm going to come back. I thought that was a great summary of the myriad of ways that you could look at this. But I think your next to last point over the people are different stages of this journey, if you will. I mean, Todd, you used a car analogy. The one I sort of think of is if we could snap our fingers and go to all autonomous cars at the same time, versus that transition might be a little bit better than, the difficulty of that transition. But if you think of the challenge for the standard setters as users and preparers are at different stages along their implementation of these tools, did you have a chance to talk about that and what that could mean?
I mean, I think we danced around that a little bit, but I think that point that you do have a bifurcation or spectrum, maybe is the better word, of different types of preparers and different types of users. In my window, I think that window between investors, between retail, and institutional is actually decreasing. So I can download 5-10Ks and put it into a GPT, and I don't think the retail investor could do that a couple of years ago. It does seem preparers have to wrestle the data issue and all the points that Stacy made as well. So maybe there's an elongating almost between the resourceful companies that can employ these tools and programmers versus smaller businesses.
Mm-hmm. Is that Deanne down there? I don't have my opera glasses to see exactly who it is.
I think this is kind of Sue's point, but from a standard setting perspective, if you set all the standards very, very prescriptively, very detailed, very prescriptively, then when you went to pull information, financial information, it would be comparable. But as you introduce judgment, principle-based or judgment or whatever, which we have a lot of areas that are judgment-based, you're going to get some noise maybe in the analysis and in what you digest through AI. And the other thing we talked about was not necessarily standard setting, but from the preparer accounting standpoint, you can assume your data is great, and you assume your inquiry is perfectly concocted. You don't have any issues, kind of from the judgment side. But if it's not, and to test it to see if it is, all of that is perfect, you need that experience, capability. You need to not be, no offense to anybody, but a newly minted graduate, right? I mean, you need to have grown up in the accounting world and be able to look at it and say, oh, well, that doesn't make sense, or maybe we got a little glitch here or there. So, I mean, there were some aspects to the practicalities of it that, we talked about a bit.
Thank you.
May, if I could just layer on there, I think that's a good, thanks for bringing that up because we missed it. I think that point about principle-based versus rule-based is it's going to be hard to balance that. I brought up the cash flow statement as an example, which is another project. And if I run the cash flow statement through AI, it hallucinates quite a bit if I'm trying to compare companies. But there's a cost benefit there, right? Should we allow principles and you can aggregate the way you view your business, or should we aggregate the way that investors use it? And I don't know if there's a right answer, but something to think about.
Christine.
Yeah, I just wanted to build on the discussion about comparability. And I think using the example of Todd with his cash flow statement, there's a difference between comparability and uniformity. And rules-based to the extent that it takes us to uniformity so that the information no longer reflects the economics is not comparability. But I do think that as a standard setter, we need to think about, well, what are the underlying economics that we're trying to get to? And on the cash flow statement, I think the problem we have is that operating, investing, and financing is not anchored in really any economic concept at all. And so you end up with a lot of lack of comparability because what is an operating activity or a financing activity can be in the eye of the beholder because how they think about their business. And so if we are going to try to strive for more comparability, I think we have to be very disciplined about thinking about what the economics are that we're trying to reflect.
Thank you. Any other comments from, oh, Stacy, I didn't know if that was up from the last time. There you go.
I just talk a lot. No, I think it's going back to the question you asked around the kind of the range of where people are in their journeys, right? I said there's different classes of people using AI. I think from a preparer perspective, I do think you're going to see companies that have more rich resources as far as availability for AI. I think you're going to see people share out use cases, right? Because I think people know that they should be able to use it. They just don't know how. But I think as soon as companies figure out how, I think the barrier to entry or to access that technology is going to be much lower than it was in the past. And so I do think you just need to have some companies like we're tasked with, right? We're given resources to use AI and so that we can show use cases so that we can share them with our customers. And so I do think that education piece is going to be super important when you think about, I say shortening the band between people that have a lot of resources and that don't.
Thank you.
But I think that
Matt.
also.
Oh, sorry.
I think we're all struggling, no matter where we sit in the table, on that last quality validation step, right? I think we focus on the tool, but there is still that conclusion, whether it's an investment decision for Todd, whether it's unleashing LLM on the COD for me, not just internal use. And then do I trust that AI output to publish, right? Publish faster with the same level of confidence. I think that's the area that we still need to kind of evolve together, right? The tool adoption, exponential. How you validate, how to have the confidence of that, what that drives your conclusion, that's the area I think we're all working together to solve.
Christine.
I would just echo what Matt and Stacy were saying. It's not just the technology, it's who's able to use the technology, the quality of what they can bring from it and be able to share that with others. And I think that's where we still have a ways to go because you can tell just even some of the largest companies are much further along in employing the technology. But then when we think in trying to, educate or train our teams, I mean, this is all new, right? We're building new teams within our companies to utilize AI. Those teams we're pulling from all different areas. So it's really, there's so many benefits and we see it, we can see it from an investor side, but as a company, there's a lot more that has to go. And we're not just employing the possibility of AI for finance. We're employing it in areas, I know, for Zoetis, it's looking at R&D, right? And how we utilize it to run the business or to, expand our scope. So I think there's so much to catch up on in this area, and it's not just applicable in the financial space. So that also goes to the cost of investment and how people are managing it.
Okay. Oh, yeah, Adam. Sorry.
Thanks. This may go in the motherhood and apple pie category a little bit, but I had a conversation with a vendor that was, promoting a tool to us. And I asked a question around, leases on the one hand that have some metrics that, some percentages used to do the accounting. And there are other parts of GAAP, as everyone knows, that are very subjective, right? And that require judgment. And so I asked that question because they were demonstrating a contract. It was a revenue contract. And I said, see, our tool will account for you under 606. And so I asked that question around judgment. And they said in the gray areas, the tool is designed to ask questions to help the individual make a determination as opposed to proposing a solution, which I thought was appropriate. Because I think at the end of the day, this is a tool for people, not the inverse. And I think that goes to the point on, well, ultimately, who's the FASB writing standards for? It should be people, and it should remain people, because there's a key aspect of what we all do is judgment, right? So again, maybe a little bit obvious, but I would just want to affirm all of that as we kind of think about how to use and harness this technology.
That's well put. Any other comments from members of the council? And I'll throw it open to the board. You've got a lot of different perspectives here. Is there anything you want to follow up on, board or the staff? Okay. Oh, Monica. Yeah.
Just one thing that Dan mentioned during our discussion that sort of blew my mind, frankly, is who is the reasonable investor in light of all the technology and these tools available to investors and the disparate sort of availability of different forms of technology. The tech that's available to sophisticated investors is very, very different than the tech and AI that is available to, as we, colloquially referred to her Aunt Millie in our discussion, right? So in thinking about how preparers are preparing this information, knowing there's a lot of efficiency that is being gained by the use of technology, but just because it's cheap to get data out, it meets the standard. Is it really being used in the same way by different users of financial statements? And just an observation that that's maybe something the board should consider.
Thank you. Stacy.
Yeah, one last point I want to make was, I think there's one thing is if you keep the outcome the same, which is exactly what we're supposed to do today, I think you can use AI to get there faster, right? It's only going to have, there's going to have limitations though, right? Because I think a lot of the time what we're looking for is waste in the system as far as how long does someone take to go and pull data together. So I gave an example of we kind of take, let's say 2,000 contracts and we have to manually adjust them because our system can't handle it. But we were used to have to look at 10,000 contracts in order to find the 2,000 that we had to adjust for. So we're using machine learning and AI to not even touch the 8,000 that we shouldn't have to touch. So again, we're getting to our financial statement outcomes faster. And I think there's going to be more areas where we can reduce waste. The other question I would ask, and I think this is more about like the standard setting, is do we actually change the outcomes in order to take advantage of AI? So again, for instance, when you think about allocation of revenue to multiple performance obligations, is there a way to, again, you're going to get a little bit further away from principles, but make it so that you can streamline it even faster? So do you have to even touch 2,000 contracts, or do you reduce some of the judgments so that maybe you're touching 100? Well, then you can even get information out there even faster. So again, one is keeping the same outcome and using AI, and the second one is how much do you change the outcome?
Rich.
Yeah. So Mike, I think you started this off mentioning this was about the 7th time we've talked about technology between our FASAC terms, and Todd, you took the credit/blame for this time. I appreciate it, but I guess I would just simply say to Dave, it'll be a recurring topic, and part of it is we're certainly, when I think about technology for the FASB, it's one case, it's how it affects our stakeholders, right? How it affects preparers, how it affects investors, and how it should therefore affect how we set standards for them. The other part of it, which I find equally helpful, and it's more in the side conversations, is how we improve our efficiency and effectiveness as a standard setter. And that's how we actually go about setting the standard, how we gather information and so on. So I value that piece just as much. We tend to get that less formally than in the FASAC discussion. But I guess this is a placeholder for Dave that will probably bring this back at some point in time, almost as a check-in, right? Of we're hearing where you are, where you think things are going. I think, as time moves on, you're going to have updates to that, and you may have different input for us as a standard setter on what we should be considering. So,
yeah, I was reflecting that maybe it was only 2 or 3 technology discussions ago the word AI wasn't used at all, right? And I think that just shows how rapidly this is changing. So you're right, but Dave told me he's going to have it all fixed in the first meeting. So good. So anyway, that was, I thought, very interesting and wide-ranging discussion. It shows the challenges ahead, I guess is a way to put it. Okay, so let's move on to post-implementation review, current expected credit losses, CECL. So I'm going to turn it over to Dan Strumer, and who's with Alex Cassis, FASB Assistant Director, and Michael DeMarco, FASB Practice Fellow.
Thanks, Mike. Good afternoon. Today, we are here to discuss the final stages of the CECL PIR process and obtain your input as we prepare to issue a CECL PIR report in the next year. Post-implementation review, or PIR, is a quality control performed after the issuance of select standards. The process includes an evaluation of the standard against its stated purpose and the costs incurred to implement, apply, analyze, and interpret. Throughout PIR, the board collects a variety of information from stakeholders that is summarized in a final report. In the handout for today's meeting, we have a pretty detailed history of the CECL guidance and the various ASUs that have been issued. And I don't plan to go into all of that detail, but at a high level, to provide some context for today's discussion, the CECL guidance was issued almost a decade ago in 2016. It became effective for public companies in 2020 and non-public companies in 2023. CECL is an expected loss model for measuring credit impairment of financial assets that are not marked to fair value, and was a significant change from the incurred loss model that CECL replaced. Before CECL, an incurred loss was recognized when the loss was probable and reasonably estimable. Following the global financial crisis of 2007, stakeholders criticized the incurred loss recognition threshold for excluding losses that were reasonably expected by a lender and its investors, but could not yet be deemed probable to trigger accounting recognition. To address that criticism of too little, too late by the incurred loss model, the board began developing alternative impairment models that incorporate forward-looking information to better align financial statements with the market's perception of credit risk. The CECL model provides measurement guidance for financial assets. Under this model, a valuation allowance for uncollectible cash flows is recorded to adjust the asset's carrying amount. There is no threshold for credit loss recognition under CECL. In other words, the book value should always equal the amount an entity expects to collect. Expected credit losses are measured using information related to past events, current conditions, and reasonable and supportable forecasts at each balance sheet date, and credit loss expenses recorded for the amount necessary to adjust the allowance to the current estimate. The board expected this to provide investors with more decision-useful information about the credit risk inherent in financial assets as of the balance sheet date, and the change in that credit risk over time. When it developed the CECL guidance, the board recognized that any approach to estimating the collectibility of financial assets is subjective, and intentionally developed CECL to be non-prescriptive and flexible. Post-implementation review of CECL commenced immediately upon the issuance of that guidance, with the formation of a transition resource group to assist practice with implementation issues in real time. The FASB staff also published Q&A educational materials on implementing the WARM method, or the weighted average remaining maturity method, and the application of forecasts to historical loss information. PIR activities have remained ongoing since. For example, the board has hosted 2 public roundtables, one roundtable in 2019 and a second in 2021, and gathered feedback through surveys, workshops, technical inquiries, and other interactions with stakeholders. The board has also issued 3 accounting standards updates to improve or clarify the CECL guidance, and a 4th ASU on purchase loans is expected to be issued in the coming months. Now that we're getting closer to wrapping up CECL PIR, we're asking FASAC members to share any observations comments, or other feedback they have. So I will pass it back to Mike for questions 1, 2, and 3 and attachment 4.
Thanks, Dan. So let's just start with the first question, throw it open to all, and then I'll point some questions at investors and then preparers and practitioners. But just general observations and insights about the history of this standard, which certainly has a history. So anything people want to share, how they've thought about this over time or what their reactions are. Oh, I'm sorry. Rich.
Yeah. Hey, Mike, maybe just a little context because wrapping up PIR it needs a little context. We're not planning on finalizing this till sometime next year.
Mm-hmm.
So the way I look at this is we've done a lot of outreach through the development of the standard, through improvements to the standard, making sure that we were targeting the right improvements, and we have some additional steps before we do wrap up PIR on this. So don't think this is being issued. Similar to what we did with leasing. You may be aware that, and revenue recognition, which FASAC participated in. We had discussions with FASAC. We had a public roundtable where we brought in all stakeholders to get a final view of where they stood with things and then prepared a final report. So we're about at least a year out from finalizing. So just didn't want anybody to think this was coming out tomorrow.
Thanks for clarifying that. Jumbo.
So in terms of question 1, the observation, I think the process to develop the CISL framework was very long. I think it took maybe 10 years or thereabout, but it was thorough. I remember participating in a number of deliberations. I was very thoughtful. I really appreciate the principles-based approach that came out of CISL. Having said that, there's a lot of diversity in practice in terms of modeling, in terms of number of scenarios, scenario development, development of variable forecasts, reasonable and supportable periods, and et cetera. So, but I think it was a very thorough, albeit very long process.
Okay. Thank you. Bet the staff feels the same way. Anyone else? Before we move into specific questions, Saul.
I'll just make it just a broader observation. I'm happy to go into details, but having, as a bank analyst, is obviously a monumental change. And I think the immediate run up to CISL's implementation, at least amongst investors, I think certainly amongst banks, there was a lot of pushback. But amongst investors, there was a lot of skepticism about CISL, and I don't think it was favorably viewed amongst most investors. I would say that sentiment has changed for what it's worth. I wouldn't say that it's universally liked or necessarily there's a consensus opinion, but I think the sentiment amongst market participants has moved more to be more constructive or at least accepting of the rule.
Okay, so we'll get into that in a bit more. Stephen.
Maybe it was just more when CISL first came on board. I think, at least from a preparer perspective, I think there was a little bit of kind of uncertainty in how to apply, particularly for the simple accounts receivable. And this is where, companies are saying, well, hold on, I got to do this exercise for AR, and I'm doing this all the time. I'm looking 30 days, 180 days, and I already have processes in place for AR, but yet we had to apply CISL even to accounts receivable. And I think there was a little bit of kind of perplexity from at least from companies that have been doing this all the time. But again, I think we got to the right place. But again, I think there was just an uptick of a lot of work. If we weren't sure, it seemed like repetitive. Now, and on the other side, there were some receivables with governments outside of some entities where they had long receivables that were past, I would say, past 6 months or even longer. And those definitely had to be addressed. But those are very specific, and we knew how to handle those. But the normal trade receivables and all that, if the question was, could have there been a simpler process? Say, look, if you have an AR that's less than 12 months, does CISL apply? That was just a question someone asked me. So just a thought.
Thank you. Tom.
Thanks, Mike. I think it's sort of looking back, we sort of came out of the credit crisis recognizing that a lot of loan losses were sort of recorded too late in the process because of the probability threshold in GAAP. And I think the um, idea that the FASB sort of got into the measurement behind that rather than just the threshold, I think led to an increase in a number of questions. And I think, the staff did a great job, I think, in trying to address those questions. I think the existence of the TRG did so. But sort of looking back, just lowering the threshold, could that have been an easier way to get there and not lead to so many additional sort of follow-on questions on something that really is an estimate? And as we look across our client base, people take different approaches to how do they develop those estimates. And so it's just sort of a question that's out there. I certainly think the incremental disclosures that came across in the standard have been helpful as well and have increased transparency for users. I also agree with Saul's comments that I think the marketplace seems to have absorbed the whole concept of CECL and sort of how reserves move through the cycles. So I think all of that has been very positive. It's just sort of the question around, would there have been an easier way to get there? I don't know if there would have been, but it's certainly a question that goes through my mind.
Thank you. Certainly, I don't think you're alone with that thought. I've heard that from others as well. So maybe following up on Saul's point and moving to investors, how do investors feel? Has this helped them change the way you've analyzed companies? Any more thoughts? Oh. I was just saying, I was following up. I think you made a point of, that it has had, there was an evolution, but has it changed specifically?
I think what it's done is I think it's made lenders more proactive in reserving earlier on, right? So during, there's an incentive to be conservative in reserving under CECL. And you saw that at the beginning of the pandemic. You saw banks true up reserves tremendously. And I think, if you think about it, if we're going into a worsening part of the credit cycle, you want to have more reserves probably than your expected loss model tells you, right? And conversely, if you're not, and you're conservative, you have embedded capital and earnings basically there in a good part of the credit cycle. So there's sort of an incentive to be, conservative. I think investors generally like that, right? Mm-hmm. So I think that's generally been helpful. I think some of the disclosures have been helpful too. For example, the requirement to have loan loss reserves by lending category. It allows us to say, okay, XYZ for their C&I book is reserved at X. This company's reserved at Y. Why is it different? You can draw comparisons about reserving adequacy, and there's some other disclosures on vintages and stuff like that that I think are helpful. So there's some things that are positive. Obviously, I think the purchase accounting change that comes up that will be, that's long overdue, but that's a positive. So I think there are various things. Now there are some caveats though here, one of which is we have not gone through a credit cycle. So I'm telling you, okay, maybe it's counter-cyclical, which is kind of maybe what is a good outcome, but could it be pro-cyclical? We haven't gone through a credit cycle. The pandemic wasn't a credit cycle. So is there an argument to be made that if the economy really turns, credit availability will suffer because you have to reserve loans for the full life at origination, and it's a bigger load, it's a bigger earning strain. So, and you have to true up your reserves earlier on potentially, right? So that part, which was an argument that some of the folks who were against CECL made, or who had concerns about CECL made, that still hasn't really been tested in a material way. And I also do think that there is some frustration, right or wrong. I don't know how I feel about it, but like I said, some of the disclosures are good, are helpful, but there's a vast diversity of practice in terms of giving you color on how you came up with those reserves. Like some companies will give you their economic assumptions in one way, other companies will give you to you another way. Some companies will tell you we would have reserved X amount more if or we would reserve X amount more if the economy, turns bad and stuff like that. And how much they give you on reasonable and supportable and, underlying assumptions that varies quite a bit. And I don't think there should be a uniform like thing, but where everybody has to do it a certain way. But you know, there is a lack of comparability or lack of uniformity that is a little wider than I thought it would have been at this point. I thought there would have been, you know, market practices would like have people converge in terms of what they disclose, and that has not happened at all.
Okay, thank you. Fred.
Just to follow up this all on the disclosure discussion, it sounds from the discussion that we need potentially to think about disclosures in two ways rather than just combined. One way is the increased disclosures about the portfolio, such as the vintage tables and some of the other disclosures, and separately the disclosures concerning the reserve and the provision itself. Do you think that would be a fair way for us to think about a separation? Because it sounds like you're thinking about some are good, some are bad. Is that a fair way to put them in the?
I'm not sure what you mean by the provision itself. What I would say is like,
I mean, the CECL reserve that goes through the income statement.
Like some of the assumptions underlying the calculation, like people get hung up on, okay, what weighted average unemployment rate did you use? I think people get hung up on that far too much. But like, you know, all the analysts, JP Morgan's weighted average unemployment or somebody's is Y and the other companies is X, and that's a sign of whether that they're conservative or not. But it does point to people trying to get a sense of what, you know, how banks are coming up with those numbers, whether it's, okay, this is your macroeconomic forecast. You probability weight it. What's your probability weight for upside downside scenarios? So there's so much in the CECL calculation. I think it would be foolish to say that you have to do it a certain way or you have to give X. Everybody has to give the same exact disclosures. But all I'm saying is that there's just a vast difference. Some give you nothing, like almost nothing. Others give you a lot of color. And so it makes it a little bit more challenging to, you know, get a sense of, you know, whether company A or company B is more conservative, and you kind of have to, you know, do it another way. I think the disclosures, yeah, that's fine. That's fair. Like you can think of it in terms of like, you know, what, you know, certain disclosures about your portfolio and your outcomes as opposed to the inputs that you're using in the model.
John Bull and then Rich.
Yeah, I think to Saul's point, sentiment has shifted around CECL, and people have come to better appreciate, understand it. Although they one or two large bank CEOs that are critical, still critical publicly of CECL. And in terms of disclosures, we do have a lot of disclosures. You know, you have the credit quality tables, but you do have a lot around the assumptions that go into the estimation, whether it be, you know, the variables, your scenarios. In fact, sensitivities are put in some of those disclosures. But I think CECL is still pro-cyclical, in my opinion. If you look at, coincidentally, CECL was, it was effective just before COVID. And so if you look at the largest four banks built $45 billion in reserves in 2 quarters during COVID. And then post-COVID, within 6 quarters, it released $41 billion in reserves. And so what happens is when the environment is stressed, you tend to over-reserve. And when things are more benign, you tend to kind of moderate and perhaps some would argue under-reserve. So it's still pro-cyclical in my view. This notion of life of loans, while it makes sense in practice, what it does is you tend to go beyond what you can forecast. So you have a forecast period, your reasonable and supportable period, but then you add on to it this reversion to historical, which, you know, my view I don't think is needed. Let's just forecast through the reasonable and supportable period, your foreseeable future, if you will, versus stretching this thing to life of loans, which, you know, there are various ways the banks look at life of loans as well.
Thank you. Anything else from Rich? Sorry.
Yeah.
Just curious, when entities were first adopting this standard and we're going through the COVID period that John Bull was describing, we heard there was a lot of investors that were doing pre-provisioning analysis, meaning they found the volatility in the reserves not helpful in their financial analysis. I'm curious, is that continuing? Because it is going through the P&L, right? We stuck it in the income statement. We didn't stick it in OCI. So I'm kind of curious, are they finding that change in this provision helpful, whether it's conservative, which we deleted from the conceptual framework a while ago, or not?
I think that there's, I think yes, to some degree. When you, it's very clear, you know, when you have a result where a bank releases or changes its, you know, assumption of estimated loss, and you see a big reserve true up because of modeling adjustments, or you know, because they change the scenario, or they're, you know, for example, having a higher downside case scenario. Yes, you know, I think people look through that and look at it. You may look at earnings adjusted for your reserve builder. You may look at earnings using net charge-offs or something like that, right? So you'll adjust it in those, you know, in those cases being in a backdrop where you really haven't fundamentally changed your view on credit. Okay, it's just an accounting issue. I think where it gets a little bit trickier, though, is where you do see a change in reserves or reserve build or reserve release that is fundamentally being driven by a change in the actual credit outlook. So if all of a sudden I trued up my reserves because I'm now more worried, or I'm seeing a very clear path to higher losses, then you won't, right? So it's a nuanced answer, right? And it will depend on whether the reserve changes are being driven by something that isn't really indicative of a fundamental change in the backdrop versus whether the reserve changes are being driven by something that seems to be real, pointing in the direction of worse or better credit.
Yeah, no, thank you, because that kind of line, some people have referred to it as being better for the balance sheet than the income statement, meaning if you're focused on, you know, what's the net amount expected to be collected, fine. But the period charges may not align with the economics that are occurring in that period.
If it's not aligned, then you adjust, basically. Then you're just going to look at your earnings based on an adjustment of what you think the economics look like, whether that's charge-offs or something like that. Then you adjust your earnings for, you know, the economics and the accounting being different in a given period in your income statement. You're just doing what you always do. You go back to what you think core earnings power is.
John Bull, did you have your card up again, or is that from the last time?
I think it was the last time, but I just share a comment. I mean, the fact that you have to look at macroeconomic variables, you can have a very healthy portfolio with all the portfolio statistics looking really good and still build a huge reserve because, you know, your macro outlook is what it is. Yeah. And then on top of that, you have multiple scenarios of the macro outlook and you weight them, and that's subjective. So if you weight in more on the adverse, you may build a lot of reserves, even when the portfolio is of very high quality and you're not seeing any delinquencies.
Ashley.
Just wanted to share one other perspective. You know, the board noted, or in the comments, it noted that the board thought about this as not changing the economics of lending as the ultimate losses. Ultimately, I mean, whether they happen in a certain period or you bring them forward, it wouldn't affect. I would say my observation as someone who does receive a lot of inbound, what we call asset-based lending or asset-based financing opportunities, is that we have a significant amount of transfer that has occurred because of CECL. That is the ostensible reason that banks or originators are sending portfolios to the private markets, particularly in the lower quality. So think of subprime, non-prime borrowers on the consumer side. So autos, student loans, and that is what we're often given as the rationale as to why a bank doesn't want to keep it, because they would have to record the full life of losses on day one, and they don't want the volatility in their financial statements over time. So that is often given to us as one of the major reasons why capital and portfolios are leaving the originators or the banks and moving into the shadow banks and the private credit and private lenders. So I just did want to share that perspective. I do think it did have a very big transaction and structuring effect. And I was laughing. I was with a manager last night and mentioned this was coming up. And they said, please just don't tell them this has been the boon for our business. So I just wanted to share that perspective. And if they're watching, I did tell you. So.
Yeah. Anything we could do to help, don't worry. Okay, thank you. For the preparer side, anything you would like to add? We're sort of talked out at the end of the day here, understandably, a lot on our plates. So that gets us to the end of the September meeting. So just a couple of reminders. This is the time of year when we're always considering future FASAC members. We have a healthy slate of people who have been recommended before. I appreciate this group. I think we have about 35 new nominations over the course of the last year, but we're always looking for new members for future years. So feel free to continue to suggest folks. Next meeting is going to be December 2nd. It'll be fully virtual. As for the last few years, we've always done the December meeting virtually. We're going to work on the topics and details of that meeting when we have our next steering committee call, which is Thursday, October 9th. As always, anyone on the council is welcome to join that in addition to the steering committee members. So thanks again for your time and a great discussion, and we'll see you in December.